Okay, everybody. I just want to check in, and I'm hoping my new microphone works. This is for the managerial accounting class that everyone it meets on Thanksgiving. So unfortunately, we're not going to be holding class, or maybe fortunately, we won't be holding class that night. So I wanted to go over chapters 21 with you, and I want to give you a little impact for this week. We are switching the order of the chapter so that I can go over some of the more challenging concepts in class with you one-on-one. So the first thing I wanted to bring up with you is this little reading from the chapter about Miss Miss Ellis Brown and her plans on controlling costs. So one of the things, this is a very normal case where a student graduates. In fact, I had one in one of my managerial accounting classes, and he actually put together a lemonade company to be distributed in Portland. And there were so many things that were going on, just the distribution and trying to understand how to price the item. When you're trying to understand how to price the item, one of the things that people don't realize is they just come in, they look at what their competitors are charging, and then they just set a price. And they're okay, we're good. But really, when you set price without looking at the cost involved, you're actually kind of limiting yourself in what you can do with the business as far as the profitability. Because what happens is, let's say you set the price at $1, but your expenses are 99 cents, and you haven't planned for that, then you're going to be running into a situation where you're not making enough money to cover your outgoing, and you're not going to have the cash flow. And that is the number one problem with small businesses. So I encourage you to read about this scenario, and then I'm going to move on to page 2. So the other thing that I noticed when I was going through your chapter is there are a lot of helpful videos within the book. So I'm going to go ahead and remind you again, read your book. Read your book. It's so important. So important that you read your book. I literally 20% of the questions that I get can be covered right there in the book. Sometimes there's even a video. So a lot of students, particularly if they're new to the McGraw-Hill product, or maybe they've been using it for years but they haven't seen all the functions, miss out on the video. So again, I want to bring that up. I'm going to go ahead and make a small overview video for you. And we're going to be talking about, this week we're going to be talking about the different actions of cost and CVP analysis, which is cost, volume, profit, so that you can actually understand how much you're making into relationship of what you're charging and where you'll hit the break even for your business, because that's usually what small business people want to know. So now, if you're going through the chapter here and they talk about the different inputs, you when you're working these problems, a lot of times students get hung up in finding the information on the sales price and the variable costs. So what I'm going to do is encourage you to read the problem. Read the problem when you're going through your homework assignment, and don't just try to scan through it quickly to get the answer. Sometimes this is frustrating. It takes a little bit of discipline, but again, I want to encourage you to do so. So the idea of relevant range. A relevant range basically means that it's the spot where you cover all your costs and you cover all your fixed costs. So we talked a little bit about last week between the differences between fixed costs and variable costs. And if you don't remember, go back and read that before you or review that before you read this chapter. But fixed costs are basically your all-in costs. For example, you have to pay your rent, and you have to pay your people, your supervisor to be there, your utilities, and so on. So it's the fixed costs stay the same no matter how much volume you have. So for example, let's say you're selling a can of iced tea or soda, and your fixed cost for rent is $32,000, which is what they kind of went through in the book. That means that no matter whether you sell one item, let's say you sell one cup of tea or you sell 32,000 cups of tea, no matter what, you're paying 32,000. So it's going to be a little while before you break even. It may take you 32,000 bottles of tea to break even before you hit that. So it's just something that you need to understand. The big thing about fixed costs that a lot of people forget is fixed costs per unit goes down as you make more stuff, and as you make more stuff. So it always behooves businesses to have a degree of output that covers their fixed costs. I think I used the example last week in class about students. The professor is there no matter how many students we have, whether we have 1 or 16, 17 students. So I am a fixed cost as a professor, and the college breaks even as they get closer to having more students. The variable costs increase based on the value of activity or the volume of activity. So again, I think I used this example in class last week about the textbooks. Pretend like the school buys your textbook. For each student, they paid like, I don't know what, $200. Then as they have more students, they'll have more costs of textbooks. So if they have 1 student, it's 200. If they have 10 students, it's 2,000. So variable costs increase in proportion to activity. So they show the graphing, and I want to show you the graphing because I think it'll help you on the homework. So what you're going to want to do is, and I don't remember if you remember from math, that the up and down line is called the y-axis and the straight side to side is called the x-axis. So what you want to do is put your cost on this y-axis and do it in increments, and then your volume on the x-axis. And you can do this in Excel, you could do it on a sheet of graph paper, you can do it on a piece of paper, but you should put tick marks for the volume and activity and then graph it out. Why do you need to graph out your homework? It's going to help you complete the first question. That's why. Okay, so here again, you can see they've got units produced, total fixed, total variable. Okay, so if you put the variable, the very first one, let's say you have a 0 units produced, you're going to be starting here, right here on this line for your fixed costs. You can't start at 0 because you have a $32,000 rent. So that's where you have to start when you start mapping out the fixed. Okay, so that's something that you need to know right here. Fixed costs will be right across. Remember, we said they don't increase on the amount of output, so they'll stay the same right here. And this is where you're going to start with your fixed cost. Okay, from there, your variable cost will start at 0 because if you don't make anything, then you don't have any variable cost. Once you start making these items at $20 per unit, they will start ticking up. Okay, and then in the third line is the total together. So the total together is fixed and variable total costs, right? So we have to start at this 30,000 line, and then as we make both fixed and variable costs will go up. So that's actually our total together. And there's an equation for this: 32,000 plus 20 per unit. Okay, so that equation is important. So let that sink in for a minute. Remember, I start at the fixed plus $20 per unit. If I don't make any units at all, my break even starts at 32,000. Okay, so that's good, important news to have. Okay, now here again in this graph, they talk about the per unit basis. So as I'm making more items, right, my fixed cost per unit goes down, 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 right? Remember, we were talking about the total cost of, let's say our room is $10,000, and if we have 20 students, then it goes down for each student. The more students, the less fixed cost per unit we have. However, the variable cost per unit stays the same. So no matter how many we produce, it's still going to be per unit. And you'll notice this is the words per unit. So we're not talking about in total. You need to make that distinction. In total is different than per unit. Okay, so down here, mixed cost. So mixed cost includes both variable and fixed cost components. So most costs are mixed because you have a little bit of you got to pay your rent, and then you have a little bit of you got to make the stuff. You add that together, and that's usually the component of your business. A little bit of fixed, a little bit of variable, okay? But there are individual expenses that can have fixed and variable cost components or individual costs. And they use the example here, salespersons with a fixed monthly salary and a variable based on sales. That could be a mixed cost, okay? Down here, it talks about the different types of mixed costs. So this is something good to know, just for your own personal knowledge, so you know which one goes in which based on the problems coming up. And I'll let you read that. Now, a stepwise cost, I love to use the example I used to use in a different class, that I use Starbucks as an example. Okay, let's say you have a Starbucks and you go out and you purchase a Starbucks franchise, and you hire a supervisor to work during the morning shift, okay? And let's say that the supervisor is, and I'm using this just kind of similar. Supervisor makes $20,000 per year. That might be kind of a low pay, but and as the supervisor starts getting busier and busier and busier, and the Starbucks keeps getting busier and busier and busier, all of a sudden you have to come in and bring another supervisor in to help the first person. Okay, so that's called a stepwise cost. It's basically a big jump up in cost, usually a jump up in a fixed cost based on current production volume. So once you get to a point where you are making so much that you need to bring somebody else in, and it pops up to the next level on fixed, then that would be a stepwise cost. Okay, curvilinear costs are a little bit different, but not much. The stepwise cost comes in chunks. Curvilinear costs are increases, volume increases, but not at a consistent rate. So you can't sit there and say, okay, I bring in another salaried supervisor. These are usually different. So, for example, they talk about direct labor being curvilinear and that they can specify in a specific task. That's one that acts a little bit curvilinear. The other one, the one from your homework, is the sales salaries. Sales salaries that have different functions. And I think the best way to do that is to read the homework problem. But in basic example, curvilinear basically is the same thing as stepwise, but it's not consistent. It's not consistent. And you can re-watch this video down here that really goes into, and I think it's a great example of how the different costs are classified. So that will get you through your first homework problem. All right, let's take a look at measuring cost behavior. And what I'm going to do is, since I have 12 minutes, and I'm going to take another break and put up a second video for measuring cost behavior. But I hope this gets you through the first little bit of the chapter, and there will be more soon.